a loophole is being plugged by making an amendment in Section 9. A couple of years back, I think in 2019, if my memory serves right, they had brought in a provision that if if a non-resident receives a gift from a resident outside India, that would also be considered to be taxable in India because it will be deemed that the gift accrues or arises in India. So what was happening was a resident in India would go outside India and make a gift to an unrelated party of say 10 CR, right? So in the normal situation, such kind of a gift would get caught under the web of 56(2)(10), right? Because it says if you give a gift exceeding 50,000, then that is taxable, and if especially if the gift is to a non-relative. But in this case, the non-resident used to argue that I'm getting this gift outside India, so there is no basis to tax it in my hands because this is a gift outside India and the income doesn't accrue or arise in India. So a change was made in 2019. Now I think the government has realized that they only covered non-residents. They did not cover not ordinarily residents in this clause. So now they have also covered not ordinarily residents in this clause. So even if a NOR receives gift outside India from a resident, he will also be taxable if the amount exceeds 50,000. And obviously the NOR is a non-relative. Couple of things I've already covered here. Yeah, this is an important one. Cost of acquisition of intangible assets shall be nil. So if we recall in section 55, self-generated goodwill cost was clearly defined to be nil a couple of years back, but they did not define what would be the cost of acquisition of intangibles or a software that you may have developed or all that. So there also now they have clearly defined that if it's a self-generated software or an intangible asset or any other right, then that the cost for such an asset will also be nil. So what was happening was a lot of people were, especially in a startup environment, a lot of people developed software or tech and intangibles, right, and sold them to other players, and they would go and argue that my intangible assets cost cannot be determined because it is indeterminate, and therefore if the cost cannot be determined, you cannot compute the capital gains because capital gains is sale proceeds less the cost, and if the cost is indeterminate, capital gains cannot be determined. And if capital gains cannot be determined, you cannot tax me. This was based on an old Supreme Court decision in the case of BC Srinivasa's FT. So this was the argument which was being taken. So I think in order to plug this, they have now clearly defined that even intangible assets and other rights which are self-developed, there also the cost of acquisition would be deemed as nil, so that you can now compute the capital gains.
Alok, in this example, what if the software company has been capitalizing some part of its salary on developers and other tech people, and they've been capitalizing for software development? So wouldn't that be a cost?
Yeah. So if you're capitalizing, not claiming it as an expense, obviously that will be a cost.
Okay. Yeah. So in your example, they were not capitalizing, and they're saying it's indeterminable to that.
Correct. Another small change that they've done is earlier, whenever a TP assessment used to happen, the TPO would ask for submission of the transfer pricing report or the transfer pricing study, right? And he would generally give a 30 days time to the SSE to furnish that report. And invariably, the SSE would also go ahead and ask or seek more time, and he would probably give another 30 days. And this was mentioned in the section. Now they have reduced the time limit and they've said that at the first instance, he will give you only 10 days and the maximum time that he will give you is only 30 days. So there was this thing which was happening where people were uh, only taking a transfer pricing certificate in Form 3CEB, but we're not getting a TP study done, formal TP study done. And only when an assessment came, they started to put together a transfer pricing study, and obviously that took time. So now all those SSCs will have to be careful and have to make sure that the transfer pricing study is there in place, because otherwise they might find themselves in trouble on this. I think one important provision which they have brought in is, again, I mean, I don't know what is the exact reason. Maybe it's something to do with stay in India, make in India, or remain in India. They have introduced the hefty TCS on LRS, or a liberalized remittance scheme wherever you're making a payment other than for education purposes. So if you're making a payment other than for education purposes, beyond 7 lakh rupees, earlier there was a TCS of 5%. Now they are seeking to enhance it to 20%. This is effective 1st July 2023. And this is also applicable even if you are making payments for medical expenses to be incurred outside India, right? So that this is a little harsh provision, and this 20% is also applicable if you are undertaking an overseas tour or taking a overseas tour package and paying to a travel agent. Still, there is a 20% TCS. So there is a clear discouragement that uh, that encourage tourism within India. Don't go and travel outside India. So I don't know. I mean, the earlier uh, intention of introducing a TCS was to keep track, but now increasing it to such high rates, I mean, it just tells you that the government doesn't want you to spend money outside India as such. Uh, okay. One good change that they've made is that a lot of times people find that their tax form 26 AS gets updated after they filed their tax returns, because some customers may have updated their withholding tax returns. And also there are cases where customers withhold tax in the subsequent year, while you may have accounted for that income in the preceding year. And it may so happen that you may have filed your tax returns and the time period for filing a revised return has also elapsed. So in that case, there was a genuine hardship for taxpayers as to how to claim that TDS, which you have already paid by way of advance tax or self-assessment tax, right? So now they have enabled that, and there is this section 155 subsection 20 where you can make an application. The only condition is that you have to showcase that you have offered that particular income for taxation in that year. And once you can showcase that, then the officer will pass an order to grant you the refund for that amount. I think, I mean, this amendment looks simple, but I think what we, as professionals, what we'll need to now ensure more is that our 26 AS entries are reconciled with what we show in our tax return, right? A lot of times people just claim whatever is appearing in Form 26 AS as a TDS. But I think there is an increased focus to reconcile the income which you have offered in your tax return and the TDS credit that you are claiming now. Online gaming has really taken off in the last couple of years, and there was a lot of talk about uh, lack of clarity on what kind of TDS one should do or how's that taxable. So the government has introduced two sections, 115 double B A and 194 double B. One providing for taxability and other for TDS. And the government has said that if you earn or if your net winnings in a year exceed 10,000 rupees, then the online gaming platform has to deduct tax at the rate of 30%. So this is another change. Okay, life insurance premium. This is again, as I said, the government doesn't want to now give any benefits to industries as such through a tax law. And they have now said that if people are making huge life insurance premiums and then claiming the redemption of those policies later as exempt under 1010D, we will restrict this. So now the restriction is that you can only make life insurance premiums of up to only 5 lakh rupees. Beyond that, if you make life insurance premiums, then the receipts that you get are taxable and taxable as other income. So if you recall, a couple of years back, they had made a similar provision for ULIPs, where there the limit was 2,50,000. But there the taxation was as per capital gains. But here in this case, they are taxing it as other income, which means the highest tax rate.
So Alok, here is this 5 lakh is per policy or 5 lakh is per assessee in a financial year?
So it is 5 lakhs in aggregate for all policies that you take. But this is grandfathered. So it won't apply to your old policies, but any new policies that you take after 1st April 2023.
But for example, policies come with all the different plans and maturities and returns, etc. Wouldn't it be very difficult, like the different policies with different tenures, and suppose the premium paid is say 6 lakh rupees, and then the returns are say when the policy matures, something is giving 20 lakhs, something else is giving 15 lakhs. How will all this be computed? Won't this really lead to a lot of confusion?
Yes, I mean, and in fact, they are going to come out with rules for this, similar to what they had come out for ULIPs also earlier. So they will come out with rules for this, and I think there will be more clarity once those rules come.
Okay, all right.
Another small change, they had introduced section 206 AA and 206 AB, wherein they had said that if people are not filing their tax returns and their TDS exceeds 50,000 rupees, then they will be categorized as specified persons, and there will be a higher TDS or TCS required to be done. So government has realized that there are certain entities which are under law not required to file tax returns. So they've said that we will exempt those cases from a higher TDS or TCS.
All right.
That's there. And I think one small thing is in order to ease the pressure on the commissioner appeals of the cases which are pending before them, they have now also authorized the joint or created another post of joint commissioner appeals to handle low value appeals. They haven't prescribed what that value should be or what category of appeals he will handle, but they have enabled that provision under this budget. And also, I think for cost accountant friends, they have now enabled the assessing officer to approach a cost accountant to verify what is the inventory valuation, whether that inventory valuation is in line with the rules, because the government thinks that the people have been deferring taxes by playing with the inventory valuation at the year end. So that's another enablement which is there.
Welcome to Complinity Technologies. Complinity is India's leading governance, risk and compliance software helping companies to manage their compliance, contracts, litigation, legal updates, inter-financial controls and more. Complinity is a one-stop shop for all GRC needs. With our proprietary 12 GRC modules and real-time legal updates on 2,000+ laws and 24,000+ compliances. All in an integrated platform that is easy to use with automated alerts and risk management capabilities. Is why compliance managers, general counsels and chief financial officers choose Complinity every time. Join the most innovative and prestigious brands that use Complinity. Automating your compliance management. Request a demo at complinity.com.